5 best tax planning tips for individuals and businesses. Hey guys, today we're going to list 5 best tax planning tips for individuals and businesses. Let's get right into it. Number 1. Invest in municipal bonds. Purchasing municipal bonds entails lending money to a state or local governmental entity in exchange for a set number of interest payments over a set period of time. When the bond matures, the buyer receives the full amount of their initial investment back. Municipal bond interest is tax-free at the federal level and may be tax-free at the state and local levels as well, depending on where you live. Municipal bonds are appealing to investors due to their tax-free interest payments. Municipal bonds have historically had lower default rates than corporate bonds. According to a study of municipal bonds from 1970 to 2019, the default rate for investment-grade municipal bonds was 0.1% versus 2.25% for global corporate issuers. Municipalities, on the other hand, typically pay lower interest rates. Municipal bonds' tax-equivalent yield is appealing to some investors because of the tax benefits. Some tax-equivalent yield increases as your tax bracket rises. Number 2. Shoot for long-term capital gains. Investing can be a useful tool for increasing wealth. The favorable tax treatment for long-term capital gains is another advantage of investing in stocks, mutual funds, bonds, and real estate. If an investor holds a capital asset for more than a year, the capital gain is taxed at a preferential rate of 0%, 15%, or 20%, depending on the investor's income level. The capital gain is taxed at ordinary income rates if the asset is held for less than a year before being sold. Understanding long-term versus short-term capital gain rates is critical for wealth accumulation. In 2021, a married couple filing jointly would pay no tax on long-term capital gains if their taxable income was less than $80,800, and a single individual would pay no tax if their taxable income was less than $40,400. The zero-rate bracket for long-term capital gains applies to taxable income of up to $83,350 for married couples and $41,675 for single individuals in 2022. A tax advisor and an investment advisor can advise you on when and how to sell appreciated or depreciated securities in order to minimize gains and maximize losses. Number 3. Consider a tax status change. If you're a small business owner, you have several options for business structure. You can run your own business as a sole proprietorship, partnership, limited liability company, S corporation, or C corporation. Your business structure will have an impact on how small business owners file taxes. If your current business structure has outgrown you in the last year, you may be able to switch to a better fit. For example, by filing Form 8832 with the IRS, LLCs can elect to be taxed similarly to C corporations. Making such an election was previously uncommon because the top corporate tax rate was 35%, but the Tax Cuts and Jobs Act of 2017 reduced the top corporate tax rate from 35% to 21%. Pass-through entities such as sole proprietorships, partnerships, limited liability companies, and S corporations do not pay corporate income tax. Instead, the net income of the company passes through to the owner's personal tax return, where the highest tax bracket is 37%. A tax status change can result in significant tax savings for LLC members in the highest tax bracket. However, it remains to be seen whether the 21% corporate tax rate will be maintained. The House Ways and Means Committee has proposed raising the corporate tax rate to 26.5%. Of course, tax savings aren't the only consideration when deciding on a structure for your small business. Number 4. Max out retirement accounts and employee benefits. Taxable income can be reduced by up to $20,500 in 2022 for contributions to a 401k or 403b plan. Those aged 50 and up can increase their basic workplace retirement plan contribution by $6,500. For example, if an employee earns $100,000 in 2021 and contributes $19,500 to a 401k, their taxable income is reduced to $80,500. Those who do not have a workplace retirement plan can get a tax break by contributing up to $6,000, $7,000 for those 50 and older, to a traditional IRA in 2022 and 2021. Number 5. Make use of a health savings account, HSA. Employees who have high deductible health insurance plans can use a health savings account to save money on taxes. HSA contributions, which may be matched by the employer, are excluded from the employee's taxable income, as are 401k contributions, and individuals' direct contributions to a HSA are 100% tax deductible from their income. An extra tax benefit of a HSA is that when used to pay for qualified medical expenses, withdrawals aren't taxed either. That's all for today, and we'll be sure to catch you all in the next one.